In today's video, we're going to deep dive into S&P Global, a great compounder that have been performing well for the last 10 years. You can see it in a lot of great investors' portfolio, and the price have a little declined lately. So we'll see if it can be an interesting opportunity. At what price can we buy the business? And obviously you will understand everything about this business in this video. So the share price is around $500 now. The market cap is 150 billion. The year-over-year performance has been 17%, P ratio of 39, the forward PE is around 30. So is it a buy opportunity? Should you buy now or the valuation is still a bit high? We'll discover this in this video. Again, the S&P 500 in the last 5 years, it didn't outperform. It did like quite same, 171%. So for the last 10 years, it outperformed, but not for the last 5. So in this video, we'll talk about the business, the numbers, the moat, the value, and of course, some potential problems that I see with this company. So history started in 1941, so it's actually starting a bit before, but the S&P Global story kind of started around 1941 with the merger of Henry Varnum Poor financial analysis firm founded in 1860 with Standard Statistic Bureau founded in 1906, created Standard & Poor's, laying the foundation of the company's modern identity as a financial data and ratings leader. In 1941, they also created the first credit ratings. The company introduced its first credit ratings, which would eventually become a cornerstone of its business. This move helped establish S&P Global as a leader in the field of credit risk assessment. In 1957, they introduced the S&P 500 index, which became the global benchmark for US equity markets. This cemented the company's role in passive investing and fueled long-term revenue growth through index licensing. In 1966, they did the acquisition of McGraw-Hill, integrating it into its corporate empire. This provided S&P with resources to expand its credit ratings, data, and publishing business over decades. In 2016, they rebranded to S&P Global after spinning off of non-financial division from McGraw-Hill Education. The company renamed itself S&P Global Inc. to reflect its focus on data analytics and global markets. This market a shift toward digital solutions and diversified revenue streams. And in 2022, so 3 years ago, they merged with IHS Markit. Okay, it's a 44 billion merge, creating a powerhouse in financial data, commodity analytics, and ESG services. This deal expanded its market reach and positioned it to capitalize on AI-driven demand for integrated data sets. So I feel that, I think there is some very good synergies with IHS Markit, so could be a good acquisition. We'll discover this in the next years. So how do they earn money? So S&P Global provides data and benchmarks to capital and commodity market participants. Its rating business is the largest credit rating agency in the world and S&P largest segment by profitability. Standard & Poor's largest segment by revenue is market intelligence, which provides desktop data and advisory solutions, enterprise solutions, and credit risk solutions, mostly in the financial service industry. Standard & Poor's other segments include commodity insight like Platts and other data, mobility with Carfax, and indexes. So the market intelligence part, it provides financial data, analytics, and research tools via platforms like Capital IQ or Panjiva. It's a subscription-based business, access to data sets and software, and custom analytics and advisory service for institutions. The commodity insight, it offers energy, chemicals, and commodity market data via Platt and IHS Markit integration. So it's a subscription fees for price assessments, example oil benchmarks, etc. And also consulting services for commodity risk management. You also have the rating, one of the most famous one. So it's issuing credit ratings for corporation, government, and structured finance products like bonds, loans, etc. Again, fee charge to issuer, company, government for ratings update, subscription fees for research and ratings update. Then you have indices, created and licensed financial indices like the S&P 500 and Dow Jones Industrial Average. Okay, so licensing fees from ETFs, mutual fund, and derivative linked to their indices, custom index design, thematic or ESG indexes. So as you can see, it's kind of a royalty business. So subscription business and a bit royalty business. Every time you will use or companies will use their service, there is a fee. So this is really interesting. Every time somebody is buying S&P 500 ETF or Dow Jones ETF, S&P Global will earn a little fee on this. So here you can see the different growth for the revenue for each part. So in 2024, the market intelligence grew by 6%, there was a rating 31%, commodity 10%, mobility 8%, and indices 16%. The total growth was 14%, and the total operating margin was around 49%. So very, very, very good. You can see that the market intelligence is growing less fast, but still everything is growing. So you have 32% of the revenue coming from market intelligence, 30% from ratings, 15% from commodity, 11% from index, mobility 11%, and other one is minus 1.3%. So yeah, here the best one for them is literally the index one, okay? 70% margin, so it's very good, and also the rating 63% margin. So those two are really amazing business for them with not a lot of competition. We'll see a bit after this. So who are the clients? Can be banks, hedge fund, asset manager, private equity firms. Okay, for market intelligence platform like Capital IQ, Financial Analytics, Panjiva, Supply Chain Insight, and LCD, leverage loan data. Also for indices, licensing of benchmark like S&P 500 or Dow Jones Sustainability Index for ETF and mutual funds, for example, BlackRock's iShares. Ratings, okay, credit risk assessment for bonds, structured finance, over sovereign debt, and ESG solutions, sustainability score, and climate analytics for ESG investing. So that's what all those bank, hedge fund, asset manager, private equity firm, they could buy. So you have some oil, gas company, commodity traders, utilities that would buy service like Commodity Insight, okay, real-time price assessment for Shell, relying on Plaid for LNG pricing. Or you have market intelligence for carbon, credit trading, analytics, or supply chain risks tool. And government and public sector, which would buy ratings, they would buy market intelligence and also commodity insight. And then large multinational startups, especially with the ones that are issuing debts, they will buy ratings, market intelligence, community insights. They will buy all of this, okay? You also have automakers, dealership, insurers, that will buy some mobility thing with Carfax, okay, vehicle history reports, telematics, data, electric vehicle battery supply chain insights, and also market intelligence about auto sales forecast or regulatory compliance tools. You have also construction companies, aerospace defense firms that will buy engineering solutions, technical standard infrastructure project database, legacy is where IH's market enter, okay, and also market intelligence with risk analytics for large-scale project. And then e-commerce firms, retailers with market intelligence and Panjiva supply chain mapping to mitigate disruptions. The sales by country, 60%, almost 61% in the United States, 23% in Europe, 10% in Asia, and 5.8% others. So the market, overall market, is expected to grow around 6.5% per year for the next decade. In the competition, in market intelligence, you have Bloomberg with its terminal, which they have 30% of market share. You have the London Stock Exchange with Refinitiv, 25%, and S&P Global with Capital IQ and Panjiva, 20%. And then you will also have FactSet with 10%. Note that S&P Global is leader in ESG and private market data tools. With mobility, you have Standard & Poor's with IHS Markit have 40%, LMC Automotive 20%, and Auto Forecast Solution 15%. Ratings, you have the trio, okay, Standard & Poor's, Moody's, and Fitch. With Standard & Poor's, Moody 40% of the market, Fitch 15%, and the last 5% is all the other. Here is a very strong oligopoly because some companies like Vanguard only accept ratings when they come from one of those three companies, or sometimes even they ask for the three companies. So yeah, it's really good business. And the commodity insights, you have S&P Global with Platts, which is 35%, Argus Media 25%. And then in indices, you have S&P and Dow Jones 30%, MSCI 30%, FTSE with a Russell 20%, and Bloomberg have 10% of this market. For the team, you have Martina Chung, which is a CEO since 2024. She joined in 2010, and Eric Above, CFO since 2024. He was the former CFO of State Street. So you can see that the team is kind of new. Like, it's new that they are at this position, but they've been in the company for long. And for Eric Above, he's been like new in the company, but not new in the industry. So they will see how competent they are, but it should be fine. For the owner, nothing particular to say. It's mostly institutionals. For the numbers now. So the growth have a score of 80%. It has been growing for the last 10 years, the revenue at 12% per year, the EPS at 5% per year, almost 6%, and the free cash flow at 18% per year. And the last growth, it's been 13% for revenue, 49% for EPS, 56%. And in the future, the revenue is expected to grow by around 7% for the next 2-3 years. The EPS by 20% per year for the next 2-3 years, and the free cash flow 6% per year for the next 2-3 years. This gives us a score of predictability of 2.5, which is not really good. It's not bad, but it's not really good. Okay, it's out of 5. So this gives us a score of almost 80%, so 79%. For efficiency, you have operating margins of 40%, okay, which is very, very good. Return on invested capital was 22% 10 years ago, 30% 5 years ago. Now it's 7% because of this IHS Markit acquisition. So yeah, because of this acquisition, now the return on invested capital is a bit lower, but it will grow again over the next years. I don't have no doubt that it will go again back over 15%. So it's just temporary, the time to digest this acquisition. Same thing for return on asset. So that's why you have a score of 66 here. For debt, they don't have a lot of debt. They have a little now, okay, 1.5 net debt to EBITDA, but very good. When it's under 3, it's very good. Debt to equity, it got decreased, so this is good, 30% now. And interest coverage is still very good, a bit decreasing, but it's still very good, higher than 10. So 87% on debt score. For the capital allocation score, they issued more share in the last 5 years, but the last one, because of the acquisition again, but the last year, they bought back 2% of the share. So I think it will continue like this, which is good. Capital expenditure very low, and stock-based compensation are very low as well. So it's good. Okay, 83% the score of allocation. And for dividend, they are king dividend, 51 years of growth track, so very good. In average, it grew by 10% per year for the last 5 years. We expect it to grow by 8 or 9% for the next 5 years as well. And the payout ratio is under 30, 25 payout ratio, 22. Very good, 82% dividend score. So it gives us an overall quality score of 77%. Here you can compare the quality score with the competitor, and you can see that except MSCI and Moody's, nobody have a better score. Okay, you have Morningstar that has the same scores than S&P Global, FactSet and London Stock Exchange don't really have good score. But S&P Global is as well the biggest. Okay, it's twice as big as Moody's. So this gives us also some good information. When it comes for the strength of the business, first one is a global leader in financial analytics, credit rating, and market intelligence with a strong reputation and brand recognition. You have also high barrier to entry. The credit rating industry is dominated by a few key players, and its regulatory licenses and expertise create significant entry barriers. You have also a diverse revenue stream. The company maintains a well-diversified business segment across ratings, market intelligence, commodity analytics, indices, providing stability during market fluctuation. It's also a subscription-based model. Okay, a significant portion of the revenue comes from recurring subscription service. So it's well for predictability of the cash flow and to create like a good atmosphere for the earnings. You also have a strong pricing power due to its essential service and market position. They have significant pricing power, particularly in the rating and benchmark businesses. Clients often require the service regardless of cost, leading to high profit margin. For example, if tomorrow they want to make the S&P 500 a higher price, they can, because you cannot really stop using S&P 500 index. Same with Dow Jones. You cannot really stop on this. So this is really good. Same for the credit rating. They can put higher price. Nobody can really stop this. And also the strength is data and technology capabilities. Okay, they had made a considerable investment in data infrastructure and technology to collect, process, and deliver financial information. This ensures the quality and accuracy of their ratings and reports. When it comes to the weaknesses, they have a big dependence on financial markets, okay? S&P Global performance is closely tied to the health of the global financial market. Economic downturns, decreased debt insurance, and reduced merger and acquisition activity can negatively impact revenue and profitability. There's also potential conflict of interest. As a credit rating agency, they face potential conflict of interest, particularly when rating companies that also pay for their services. Maintaining independence and objectivity is crucial but challenging. The conflict of interest, you saw it during 2008, a huge crash, okay? This is what we talk about. You also have a big competitive pressure, especially in some area. Increasing competition from tech-driven financial data provider could impact market share and pricing powers. Like the market intelligence, that's why it's growing less fast, because you have a lot of competition on it. Limited geographic diversification, you have 60% of the revenue coming from United States. So this, if you have a big problem in the United States, you have problem here. You also have a dependence on key employees. A company's success is heavily dependent on the expected knowledge of its key employees, particularly those in senior leadership position. And then integration risk from acquisitions. They have grown, like lately, S&P Global have gone through acquisitions, and integrating these companies can be complex and time-consuming. Failure to effectively integrate acquisition can lead to cost overrun and loss of synergies. Also, if you pay them too much, it can be problematic. For the opportunities, you have the growth in emerging market, okay? As emerging markets continue to develop, there is an increasing demand for credit rating, financial data and analytics. S&P Global can expand its presence and service in these regions. Increased demand for data and analytics, okay? It's an overall market which is growing. There's always more and more company needed those data, so this is good. Expanding into new asset class, okay, they can expand its coverage to new asset classes such as private credit, digital assets, to capture new revenue streams and diversify the business. You have technological innovation, okay, they can leverage new technologies of AI, machine learning to improve its service, automate process, and develop new products, increase margins, and so on. Even if they have high margins, they can always increase a bit more. You also have private market data. Increasing investor focus on private market data creates demand for more comprehensive private company data and analytics. And also the climate analytics, okay, it's a growing demand for climate assessments tool from corporation and investor represent a significant growth vector. The threat, okay, you have the increasing competition, particularly in the market intelligence with Bloomberg, FactSet, London Stock Exchange with Refinitiv. So here you have a big pressure on the margin, you have the big pressure here, and you may have some pricing fight, like the one with the cheapest may have the client. So here you have some problem here. Then you can have regulatory change. Okay, this is affecting everything, but with credit rating and financial data, that can impact the business model and increase compliance costs. Economic slowdown, I think it's the biggest threat. Okay, macroeconomic weakness could lead clients to reduce spending on financial information service and analytics. The reputational risk, like in 2008, like it was crazy. So rating controversy and data breaches could damage brand integrity and customer trust. And it's not the first time this already happened, so it can happen again. Cybersecurity risk, okay, they are vulnerable to cybersecurity because they have so much data. So if there is a cyber attack, a breach, that could create problem, because if they provide data and you have a cyber attack and they cannot provide the data anymore, the client will be pissed. They will not pay the fees, they will not pay the subscription. So here you can have some problem. And also some geopolitical risk, okay, rising geopolitical tension and trade wars can impact global markets, leading to instability and reduced demand for S&P Global services. For the product, as a product essential, yes, you having market data and credit rating are must-have for a lot of companies. As the sale predictable, is there any regularity? Yes, most of the revenue are recurring and they are fees-based. Is it a wide market with ton of clients? No, it's mostly big corporation, bank of government. So you still have a lot of clients, but it's not like Apple, which will sell an iPhone and literally everybody in the world could have an iPhone. Here, no, it's less. Is it difficult for clients to change to competitors? Depend which part, but generally you don't change your market data provider. So once you have a client, you stay it for long. Has the product resilient to change and innovations? Yes, it has been more than 5 decades that the business is working the same way. So very good. As a market leader, yes, in most of the areas of operation, they have market leader or close to be market leader? Is the market open or closed? Can competitor enter easily in the market? It's open on the data, but closed for the rating. For the rating, you have the big three, and after this, that's all. Or for the data, you have a lot of competition, so it's open, not really good. As a price maker, yes on ratings, and on indices and so on, but on data, absolutely not. Is it easy to forecast the growth? Yes and no, because it depends on the global market condition. When the global market conditions are good, we don't have an economic downturn, it's kind of easy, but we can never predict this kind of things, the economic downturn and so on. So when there is no economic downturn, yes, but when you have this, less. As it depends on geopolitics, not really. Is it easy to find new clients? Yes and no, because on rating, yes, it's easy. On data, there is some competition, so more difficult. But on ratings, index, easy because they are the only solution. Like you must go with them, so kind of easy. The management, does the growth come from outside or inside? Both. They have been good with acquisition historically, so it comes from a bit outside. Generally, they have been done well with this. Is it easy to manage a company? Yes, not a lot of capex. It's a fees business, so not a lot of things to do, just making the things work. Is the company focusing on creating good products? Yes, they are constantly trying to improve the product, improve the deliverability, improve the client relation, so yes. Are the important team members good? Yes, they seem to be honest. Generally, the guidance are pretty good. They are kind of honest with shareholders, except, but this, let's hope it will not happen again, except in 2008. But generally, they're kind of honest. When it comes to the moat, the Morningstar rate is wide moat with a stable trend, which is good. The return on invested capital is over 20% historically, but decreased with last acquisition of IHS Markit. The switching cost. Yes, there is a switching cost. For most of the segment covered by S&P Global, it's difficult for clients to change to competition. Do they have a pricing power? Yes, especially on ratings. Less on market intelligence because of competition, but on ratings and on indices, yes. Does they have a network effect? Yes, with rating, index, plat, commodity, and mobility, Carfax, good network effect. Is the tangible asset important? Yes. One of the most famous, maybe most famous index is S&P 500 and Dow Jones. Also, credit rating can represent a strong intangible asset. Do there is an efficient scale? Yes, due to the large number of clients in the credit rating industry, they have it as well in the commodity inside with Platts. And does they have a cost advantage? Not really. So here my question, problems that I see with this company. First, the dividend. Where is it going? Because it doesn't increase very fast. I hope they will not be trapped by the king dividend statue and be able to do massive buybacks in case of a fall. Like, I don't want them to be trapped. They shouldn't because they have 25% payout ratio, but still, I don't really understand the thing with the dividend here. It's fine, but like only 1% dividend, not really good. How will it do if there is a recession? We already had a long run without a massive recession. With actual valuation, isn't it better to wait for a recession to enter? Because as you can see, in 2008, after the recession hit, the revenue got divided by 2. From 2008 to 2010, it got divided by 2. And then you have a great run after this. But without this, like, does it seem nice to wait for a recession to invest in this business? This can be also a good question to ask. So the guidance for 2025, the revenue is expected to grow between 5 and 7%. The operating profit margin expected to grow from 49% to 50%. And the diluted EPS supposed to grow by between 8 or 10% for the year. The division revenue and margin outlook, okay, market intelligence between 5 and 6.5 overall, and index between 8 and 10%. So let's go with the value now. The price is $500. The average PE ratio for the last 10 years has been 32. So actual PE is 41. The forward PE is 30. And expected revenue growth rate 6% per year. Expected EPS growth rate 15% per year. So let's see here the different scenario we can have. So we expect 15% growth rate for the EPS. So let's say we have 13 from here, and let's say they do 2% buybacks every year for the next 5 years. You will have a cumulated annual growth rate of 10% without dividend, 10.6% with dividend if you have a PE ratio of 30 and a growth rate of dividend of 9%. This seems pretty honest to have 10% per year. If you want to have 13% per year, you need to buy around 450 if you think this is a scenario that could happen. For me, this doesn't have enough margin of safety. So I will put minus 1% of buybacks here, and I will put 11% growth, okay, for the net income for the next 5 years. 11% per year with 1% buybacks. You have a P ratio, I would prefer to put around 28, even 27. Okay, here you need to buy at 356, so you need a decrease of 30%, and for now you will have a cumulated annual growth rate of 4.7, 5.5%. So for me it's a bit, like it's not deeply overvalued. It's a bit expensive, yes, but it's not deeply overvalued. The margin of safety are just not big enough for me, okay? But you can still have something good if they do 15%, like 13% like this, and 2% here, and they have a P ratio at 30. The average for the last 10 years was 32. You can still have some performance, but for me there is not enough margins of safety. So at least you should wait under 450 to buy. But then it depends what you want. It's also a very stable business, kind of a safe business. So yeah, it really depends what you are looking for. For me, it's a bit expensive right now. So I give it a value score of 15%. So the conclusion, first, is on my watch list. I put it on my watch list because, yeah, I believe it's a great stock, great numbers, and so on. It remained a cyclical business considering the long run we had in economy since 2008. I'm not very comfortable buying S&P Global right now. I like that it's a fee-based business, so predictable and very profitable. They have a great moat and well-known product. So even with a forward PE of 30, it's a bit expensive for me. It's the kind of business I would love to buy during an economic downturn, but for now, I will allocate my capital to less valued business. So I keep it in my watch list. If we have a recession that hit or a scandal and the stock get down like 30%, I would probably be one of the first to buy. But for now, I feel it's still a bit expensive. I will not buy it. Let me know in the comment section, what do you think about this business? It's not because I will not buy it that you cannot make a great deal by buying it, okay? It's just my personal view on this. I'm giving you the reason why it's not in my portfolio right now, but it's still a business that I'm following closely and it's still very interesting one. So that's all for this video. See you on the next one.